What if the key to building real wealth wasn't some flashy stock tip, viral meme coin, or next big thing from a TikTok influencer, but two quietly powerful ETFs hiding in plain sight? While the masses chase quick wins and risky trends, smart money, including institutional investors, hedge funds, and elite financial advisors, is funneling billions into two Fidelity ETFs that most people overlook. These funds are outperforming the market, delivering consistent dividends, and doing so with lower fees and more innovative strategies than the big names like Vanguard and Schwab. If you've ever wondered how to invest wisely, how to make money in the stock market without stress, or how to build an investment portfolio that grows while you sleep, this is your answer. This isn't theory. It's proven performance backed by real numbers. And whether you're a beginner learning personal finance, a Dave Ramsey disciple searching for passive income, or someone playing catch-up on retirement planning, what you'll learn today could completely reshape your financial future. Welcome to Trailblazers Mindset, where wealth builders come to get inspired. Let's dive in. Firstly, let's discuss why I'm consistently motivated to invest in Fidelity funds, despite still considering Vanguard and Schwab two of the industry leaders. Fidelity continues to stand out as a powerhouse in the investing world, consistently outperforming other leaders due to its dynamic strategy, cutting-edge innovation, and investor-focused design. Unlike Vanguard, which primarily emphasizes passive index investing, Fidelity takes a hybrid approach, offering both passive and actively managed ETFs that utilize smart screening for fundamentals such as profitability, valuation, and growth potential. Its enhanced index strategy, seen in funds like FELC, blends the stability of index investing with the precision of active management, resulting in more substantial returns over time. Another key differentiator is cost efficiency. Fidelity ETFs are among the lowest in expense ratios, with no minimum investment requirements, making them ideal for both beginner and experienced investors. Combine that with Fidelity's DRIP, Dividend Reinvestment Program, and fractional share investing, and you get unmatched accessibility, flexibility, and long-term growth potential. Bottom line, Fidelity isn't just keeping up, it's setting the standard for what smart, modern investing should look like. It's built for those who want financial freedom faster, with less guesswork. Before we continue, if you find value in this video, please hit the subscribe button to join our growing community. We appreciate your support. Thank you. Let's dive into the first ETF, Fidelity Enhanced Large Cap. Core ETF ticker symbol FELC. Think of FELC as your upgraded S&P 500. Instead of holding all 500 companies, it selectively invests in about 217 of the best. Using AI and smart screens, it chooses companies based on real business fundamentals like profit margins, revenue growth, return on equity, and balance sheet strength. It's not about being big, it's about being better. Most index funds, such as SPY or VOO, invest based on market capitalization. The largest companies receive the most investment. FELC flips the game by picking winners based on performance, not size. It boasts an annual return performance that is 3% higher than the S&P 500. Let's break it down, assuming the S&P 500 yields 10% per year, which, by the way, is not shabby. However, FELC delivers around 13% annually, based on current performance trends. The math is simple. If you invested $50,000 into the S&P 500 and got 10% per year for 15 years, you'd have about $208,000. With FELC at a 13% annual return, you'd have about $354,000. That's a $146,000 difference, with zero extra effort. I will provide the breakdown of the potential returns after 20 years in a few minutes. Stick with me. The second ETF is the Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. If you're interested in growth, this ETF should be part of your portfolio. It is Fidelity's answer to Vanguard's VGT. They track the same index, meaning you get exposure to the same tech giants: Apple, Microsoft, Nvidia, Meta, AMD, and many others. But here's what makes FTEC better. 1. Lower expense ratio of 0.08% versus VGT's 0.09%. 2. Lower share price, approximately $203 versus $600. 3. It boasts better performance over a 10-year period. The average annual growth return over the past decade is 19.54%. Think about that for a minute. Now let's do the math again. If you invested $50,000 in FTEC and earned 19.54% annually for 15 years, you'd end up with approximately $924,000. By the way, that's not a typo. That's nearly $1 million from just $50,000, and it's all based on historical data, not some fantasy projection. Before we continue, if you find value in this video, please hit the subscribe button to join our growing community. We appreciate your support. Thank you. Next, let's discuss the power of combining FELC plus FTEC. By combining these two ETFs, you get the best of both worlds. FELC gives you solid, diversified core holdings that beat the S&P 500, while FTEC gives you explosive growth from the tech revolution. Together, they form a balanced investment portfolio focused on long-term wealth creation, dividend investing, and passive income. Let's illustrate the numbers. Assuming we are implementing a strategy that involves splitting $50,000 between the two ETFs. An investment of $25,000 in FELC at 13% for 15 years will yield approximately $177,000, and an investment of $25,000 in FTEC at 19.54% for 15 years equals approximately $462,000. The total portfolio with this strategy after 15 years will be $639,000. Outstanding, right? But wait, what about 20 years? Always remember that long-term investing is where the magic happens. Let's run it again with a 20-year horizon. For FELC, an investment of $25,000 with an annual growth rate of 13% for 20 years will grow to $318,000. And for FTEC, an investment of $25,000 at an annual growth return of 19.54% for 20 years will grow to $1,128,000. That's a total of about $1.45 million. Think about that for a minute. Now imagine you added $500 per month on top of your initial investment. Over 20 years, this simple strategy could potentially grow into over $3.3 million, thanks to the power of compound interest and consistent dividend reinvestment plan. Again, this is not magic, it's math, and it has been proven to work. This is not just about how to make money, it's about building financial independence. Your investment strategy shouldn't be based on hype. It should be based on historical performance, smart design, and consistency. Many people believe that saving is enough. However, the truth is that it isn't. Inflation eats savings. The only way to outpace inflation, build wealth, and achieve true financial freedom is through investing. And not just any investing, but smart ETF investing. If you're serious about building real wealth, then consider this channel as your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth together. If you are interested in how savvy investors are turning $20 a day into $1.4 million, check out our video on that topic. The link is in the description. Please note that we are not financial advisors. This content is for informational purposes only. Click on the next video on your screen. We appreciate your support. Thank you.